Here's why the US is helping prop up the Japanese yen. When the yen recently hit its weakest level against the dollar in about 40 years, it wasn't just Tokyo's problem, it was Washington's too. The US Treasury Department took the rare step of joining Japanese officials to intervene in currency markets, adding American financial heft to an effort that had already seen Japan spend tens of billions of dollars this year trying to boost its currency. The reason is straightforward: the United States and Japan share deep economic and financial ties. Japan holds nearly $3 trillion in U.S. treasuries, stocks, and other assets. It's the largest foreign holder of U.S. treasuries, with more than $1.1 trillion in holdings. That means turmoil in Japan can ripple through U.S. markets and beyond. Here's the chain reaction officials are trying to prevent. If the yen keeps sliding, Japan might sell significant portions of its treasury holdings to fund further intervention. Selling treasuries would push down their prices and raise yields, which means higher borrowing costs for the U.S. government. And those costs are already climbing. Last week, the yield on 30-year U.S. bonds hit its highest level since 2007, driven partly by inflation concerns. A weak yen also means a strong dollar. That hurts American exporters by making their goods more expensive for foreign buyers, while giving Japanese exporters a competitive edge in the United States. Last year, the U.S. imported $146 billion worth of goods from Japan and exported about $82 billion, according to the Office of the U.S. Trade Representative. The intervention also has a regional dimension. Moves in the yen influence other Asian currencies like the South Korean won. Supporting the yen reduces the risk that other Asian countries come under intense pressure and need to sell their own dollar reserves to prop up their currencies. As John Bromhead, an economist at Moody's Analytics in Sydney, put it, for Washington, supporting the yen is relatively low-cost insurance. This wasn't the first time this year that volatility in Japan's markets caught U.S. attention. In January, the Treasury Department considered a yen intervention after Treasury Secretary Scott Bessent blamed a rise in Japanese bond yields for driving up U.S. government borrowing costs. It's not clear how effective the intervention in the yen will ultimately be. Japan's efforts so far have had limited effect. But the coordinated move underscores just how interconnected the global financial system has become and why a currency crisis in Tokyo can quickly become a bond market problem in Washington. That's the story. Thanks for listening.